Take a listen to the Sunday night video that we put out about the Apple conference. Some of the biggest catalysts that you gotta watch in the broad markets, really over the next 12 to 24 hours, is going to be number one, the Apple conference. The saying, buy the rumor, sell the news. You've seen Apple go higher because investors have been buying the rumor of like a VR headset and other things coming, and it's possible that they sell the news Monday. Now that's exactly what happened. Apple stock hit a new all-time high, actually surging well past its all-time high, and was up about 2.5% before this conference. And where we currently sit as we are closing out the markets, Apple stock is down almost 1%. It did a complete 180. And while I don't have a crystal ball, this was pretty easy to see. Now I want to go over what's coming and what potentially could happen to our markets, because it's easy to say coulda, shoulda, woulda to things that have already happened. But what can we see coming from this? That's what we'll break down here in this video. And if you guys want to stay up to date with the latest that is happening in our markets, you know what to do. Now, Apple priced these headsets at $3,500 a piece. The average analyst expected these to be priced at about $3,000. So $3,000 was out of reach of most of Apple's consumers. $3,500 is even further out of reach. So while a lot of people had a lot of hope for this VR headset, with the price point the way it is, it's going to take a while before you can have a broad customer base that can afford these. And I think that's the ultimate problem. Analysts were heading into this thinking this would generate tens of billions of dollars of revenue a year in as soon as 2 years from now. At these price points, that's never going to happen. So I think it crushed some of the optimism here with Apple. And I don't really expect any material change to Apple's business in the next 12 months based off of this. They say that they're going to start rolling these out in the beginning of 2024. It's going to be a slow and steady process. They're targeting between 200 and 300,000 units to be sold in 2024. That's not really moving the needle for Apple. And while investors like to think they're super long-term invested, well, most of the time not. Most of the time investors want to see, earnings higher and revenues higher and new products getting built into their consumer ecosystems within 6 to 12 months. They don't want to wait 5 to 10 years. Ultimately, my personal opinion, these are pretty cool. There's a decent chance these things catch on. But the price point has to be lower. And when does the price point go from $3,500 to the price of an iPhone? Call it $1,000 or even $1,500. It's probably going to be a long time before that happens. So for those reasons, Apple stock sold off after hitting a high today of almost $185. Now, it also did not help Apple stock. The analysts were trying to front run a rally after this event, meaning that analysts started upgrading their price targets aggressively in the month of May. And even today before this event, you've seen 3 upgrades to price targets before this event started. One of them was from Evercore ISI Group. They changed their price target or their rating to a buy. With their former price target of 190, they increased that to 210. B of A Securities increased their price target from 175 to 190. And Daniel Ives from Wedbush increased his price target to $205. It looks like everyone was expecting a lower price point for these headsets and would equal faster adoption. And almost everyone expected a rally out of Apple. Now that expectations have gotten upset, what's going to happen from here? Well, Apple is the largest component of the S&P 500, the second largest component of the NASDAQ. So when Apple gets good news, it can drive up the whole markets. When things turn sour for Apple, it can affect the markets very negatively. Now, the markets in 2023 have done exceptionally well on an index basis, but the average stock has done very poorly and is negative for 2023. Your largest 7 mega cap tech names have done all of the work for the indexes. So what happens from here, and this could be the start, would be big tech coming down to match the rest of the markets, or it would be your smaller and mid-cap names start to move higher and to match up with big tech. If the latter happens, you're going to all of a sudden find yourself in a much healthier market. Now, if the markets crash from here or hit new all-time highs, it comes down to factors that really have nothing to do with Apple. So while this is very negative for the markets, it's not an end-all be-all. The markets have to crash from here. Matter of fact, the NASDAQ was actually positive today. And we actually got indications that service inflation is probably going to be falling from here. And that's really the sticky part of inflation that hasn't moved around too much. This data was the ISM Services PMI for the month of May. The headline number was expected to come in at 52.2. It came in at 50.3. Factory orders came in 100% better than expectations at 0.4%. Expectation was 0.8%. ISM Services Employment came in at 49.2. You were expecting 50.8. ISM Services New Orders came in at 52.9. You were expecting 56.2. ISM Service Prices came in, and this was the big one, came in at 56.2. You were expecting 59.7. ISM Service Business Activity came in at 51.5. You were expecting 52.1. So on all counts of market expectations, out of all of this service data, none of them were worse than expectations. They all came in much better. And this is really the first time this has happened, where everything actually fell. So this was a very positive for this market today. A big negative catalyst, though, while we're on the economic calendar, is going to be the Treasury issuing massive amounts of bonds. I know you've heard this already, but by the end of 2023, you're expecting about $1.4 to $1.5 trillion worth of bond sales. This is going to be the largest year of bond sales in a very long time. The Treasury is trying to reload their bank account, per se. It's called the TGA, the Treasury General Account. It pretty much went to zero as we were facing a possible default. They got to fill that up again. So it's kind of like taking money out of different investing avenues like stocks or corporate bonds, corporate credit, just overall bank accounts. It pulls liquidity out as the government dumps these bonds onto the market. And you've seen the first bit of bond sales earlier in the day today with the 3-month and the 6-month bond auctions. The yields on these came in at 5.22% for the 3-month and for the 6-month at 5.25%, kind of indicating that some bond investors are expecting yields to stay around that 5.25% range over the next 6-month period. So this is kind of pushing back a little bit on the odds of a rate cut by the end of this year, which, believe it or not, is a positive thing, because if the Fed is cutting rates, especially when inflation is nowhere near 2%, then that would be because the economy is doing terrible. And ultimately, markets freak out about the Fed raising rates because it leads you into a recession or can lead you into a recession. So a recession is the ultimate thing that the markets fear. It's not really the rate hikes that the markets fear. It's the rate hikes will lead to a recession. And that's what the markets fear. So good news on the front of inflation today. But if you ask Morgan Stanley's Mike Wilson, he wouldn't agree with that so much. Mike Wilson sees an earnings wipeout ahead for Wall Street's unloved stock rally. What he said today was that markets have yet to price in an earnings recession. Mike Wilson thinks earnings will fall 16% year over year. And we're not expecting that, especially when you look at big tech the way it is, when you look at the S&P and you look at the NASDAQ, breaking out up 20% on the S&P, up almost 30% on the NASDAQ. You're not expecting an earnings recession, which does make a lot of sense to me. Now, he says that Morgan Stanley expects for a bigger stock drop, but they have been kept at bay by the outperformance of AI players and some big tech names. Fed pivot fever and hopes we've been through the worst of an earnings recession, but a major repricing has hit lower quality, cyclical, and small cap stocks, he adds. And that's exactly what I said earlier in this video with the market breadth. Either these sectors, your lower quality, cyclical, small cap stocks, catch up and really bounce from here and try to match big tech, or big tech falls down. And it looks like Mike Wilson thinks big tech's going to come down, not necessarily that cyclical small cap stocks are going to catch up. Now, the strategist also gave us a little bit of guidance. He says that you really want to watch the equity risk premium. And this is the portion of the price to earnings PE. Now, if you don't know what ERP is, it's the difference between the expected earnings yield and the yield on safe treasuries. So if you're expecting like a call it 5% or 10% yield, let's keep the math simple here. If you're expecting a 10% yield on earnings growth in a company, and bonds, your risk-free assets, yielding you 5%, well, your risk-free premium would be like 500 basis points, right? Well, your risk-free premium right now is more like 100 basis points. And what this chart shows is that during times of stress and before market crashes, you get risk premium shooting higher. And this happened in 2008, this happened in 2011, this happened in 2019, this happened right before 2020, and it goes up by 200 to 500 basis points. And you're at the lower end range of this, basically saying that you've priced in a lot of good news in this market. Now, maybe Apple was the first domino to fall, and maybe big tech as a whole will come down. After all, I've said this before here on the channel actually quite a few times, that certain indicators you just cannot ignore. One of them being on the NASDAQ, the weekly RSI. On the weekly RSI, every time you have went over 70, which is the technical overbought level, you have fallen quite a bit. Back to 2018, 2019, same thing. You get overbought on a weekly chart, you come down in the index. Same thing before COVID. Got overbought, came crashing down. Same thing in 2021 in November. You got overbought, you came crashing down. But it doesn't have to happen immediately. And we did see that in 2020, where there was a little correction. This correction was about 11%, give or take, which is sizable. Let's not discount that. But you didn't crash 20 or 30%. And you can stay close to the overbought level on the RSI for a decent amount of time before that crash ultimately does happen. Before COVID, you were overbought in the RSI for a couple months. But it ultimately does lead stocks to go lower, or at least is a good signal that stocks are going to go lower. And as of about 3 weeks now, you have been overbought on the weekly RSI. And if you just look at the performance of the NASDAQ or something like an Apple, it's been virtually straight up. To see some give back here
makes some sense. And specifically when you look at Apple, your next level of support on a downside move is around 173. So that would be downside of about $6 per share. That would bring down the index probably 2% alone based off of Apple's drop. Depending if the rest of the markets start to fall, well, that's something that we just simply cannot forecast. But moving averages, as well as other technical signals, would suggest the markets are overbought, and you can expect the markets to come down or at least trade sideways for a while. And that's kind of my base case expectation, but it doesn't have to happen immediately, and I want to reiterate that again. I think especially if you're trading this market, you can afford to wait until you can confirm that the markets are going to fall when there's a stronger bear case. If inflation maybe went higher in the service sector today, that would be another sign like, hey, markets might need to fall. But you're just not getting enough bad news to actually see that. Let me not forget to include this. ISM services falling is very recessionary data. So it's good for inflation, a bad sign for the economy. There's no telling when the recession narrative will take over again, and when markets will stop caring as much about the next Fed rate hike or when the Fed's going to pause. Eventually, it will happen. Eventually, markets will care about a recession more than the Fed again. But it could be a while. So that's what I have for you here in this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section, especially if you want to stay up to date with everything happening in this market. You guys have a great rest of your day, and I will see you in the next one.